Welcome back, folks. This is our midweek review for the ICT Mentorship for September 2nd, 2020. Man, we are in the latter portions of the year already. As bad as this year's been, it is moving along. So, let me just state before we go into this, I'm expecting some really nice trading for September. Typically, we have a lot of seasonal tendencies come in this month. It's usually about the second week into the end of September where we start to see a lot of really nice price action. Add to that, we have the increased likelihood of volatility because of all the things leading up to the U.S. election, all of the uncertainty of whether or not there's going to be a wave 2 of COVID, or if everybody's going to wake up and say this is enough. So there's just a lot of things that I'm really anticipating in the form of volatility. So with that said, we're going to go right into this, and I'm going to start with the lower time frames and then finish with the higher time frame as the latter portion of the video. I'm going to try not to be too long because I gave you guys an hour and 45 minutes yesterday in a YouTube video. If you haven't watched that, the main thing I want you to take away from that video was, number one, go through the most recent downdraft in the daily chart on the dollar index. As I mentioned publicly, that if everyone would just go through that and count the number of down days, and then look for all of the selling opportunities, even with the free level tutorials, that measure of understanding, and then include what you know and have learned in the mentorship. And I think you're going to be pleasantly surprised how many opportunities are there. So I think we may be, and I want to make sure I say this carefully, okay, because sometimes the individuals that are in our mentorship sometimes are extremely sensitive to me saying things, and if they hear something that's very close to what they want to hear, they just dogpile in and do the very thing that I'm trying not to entice you to do. But I'm going to go on record and say that we could potentially be seeing an intermediate term low in the marketplace for the dollar. That means there's an intermediate term high forming in euro and in cable. Now, that is not a high that tops the market and bottoms the market. It just means that we have the likelihood of seeing a very tradable bounce in dollar higher and lower with euro and cable. So again, just take it with a grain of salt. Okay, I don't want you to read too much into it and get too overly confident about the likelihood, because I try not to try to pick tops and bottoms, and it's important for you to remember that. Okay, but what am I saying? I'm willing to test the waters with my own trades if everything lines up. Okay, if I see things that would line up that would support this idea, then obviously I'll go in and participate. But I'm not going to be using my maximum leverage. Okay, I'm going to be using 1%. Okay, so whatever that translates to you, if you're using your demo account, dial back the leverage that you would normally use and risk if you're going to be practicing with the same thing in mind. All right, so we're looking at the dollar. This is our hourly chart, and you can see last Thursday's PAL comments and employment numbers and all that, and we whipsawed back and forth, targeted the lows as we were looking for, came down, swept the 92 level, went into the 91s, cleared the 91.80 level, and now we have since traded back above the fair value gap that's on the daily chart that we've been outlining for a long time now. Buy-side liquidity here has my attention. Okay, I think that we could potentially draw up on that. I'm not sure what this has happened, but we still have our chart. I got scared. I thought I was like, lost all my annotations. But we have the buy-side liquidity pool here and potentially a market maker buy model. Okay, so I'm looking at this fractal from this high to this low and working within the context that we might trade back up into the 93.50 level. Okay, so how we trade there, if we trade there at all, I might be wrong, okay, but I'm going to try to operate with that context going forward. Now, if we lose 92.20, okay, if we go below 92.20, then we resume going back lower, and I'll abandon the idea that I'm outlining here. But as long as we're above 92.20, I think that it's within reason to try to press up into this area up in here, okay? And again, that's what I'm going to try to work with my own trading. So we have one level here at the institutional level. It's 20 pips below the 92 big figure. We have the breaker here. We traded down into that. And now, as I mentioned in teaching the market maker buy and sell models, the curve is this low. So you take a line and draw that up. So everything on the downside here that leads to up close candles has to match with a buy on the right side of the curve. So this candle's high here matches with this buy with a fair value gap, and breaker rallies up, comes back down into institutional order flow, rallies, comes back down into this candle's high. It's the up close, not the down close candle. It's the up close. Let me zoom in here. I know a lot of you guys watch me do this TradingView platform and say, I wish ICT would just do this or that. I am so familiar with my own personal trading platform that I got so used to using MT4 coming to TradingView and still using eSignal. It's just a lot of things to remember, and my mind says to just move things around the way I'm used to doing it, and it's probably very irritating for some of you, but I don't mean to be upsetting. But I've since appreciated this little tool. It's been staring me in the face the whole time, but I don't know, I just didn't want to see it. All right, so this up close candle, not the down close candle, that's what I'm highlighting. You can see how the price is respecting that. Okay, the bodies are supporting it. Bam, hits it, rallies up. Just like this candle's high. Hits it in here and rallies. So now we're consolidating again. We have a bullish order block. I'd like to see it really stay above this candle right here. Now, if we drop that back down in here, we can find some rebalance at this point and then work into this candle's body. I'd like to see it not do that. I'd like to see it just really press from where it is now and go higher and attack the buy side liquidity pool that's at 93.50 level, as indicated before I zoomed in here. I'm going to drop into a 15-minute time frame. All right, so here's the 15-minute time frame on the dollar. You can see all of the levels that is outlined on that hourly chart. It's just really uniform, and it's been providing just a nice stair step higher, as you would expect with a market maker buy model. But let me zoom out just a little bit. We are from this high to this low in a premium. So that's why you would be demanding, and what do I mean by that? Let's add the fib. Okay, so we are up in the 70.5 level we went to here 2 times and then came down. That's why I'm demanding price show me an unwillingness to go back below that hourly down close candle that was a bullish order block. I said as long as it doesn't go below that. It did. We would go into this area here and rebalance. But that would be the less likely high probability scenario. And I probably didn't say that correct, but let's say it again. Given the current state of the marketplace right now, we are in a premium relative to this range high and low. With that said, I believe that we could still press higher, and because of that, I don't want to see a lot of downside. If it does, it needs just to rebalance here and then reject that hard and go higher. Otherwise, we will move back below the 92.20 level, and any short-term bullishness I have now that would be viewed as a run to 93.50 would be neutralized for the time being, and then I would resume my bearish stance on dollar. But right now, I don't want to be bearish dollar. I'm giving it the benefit of the doubt that we may be having used this area here to key off of for an intermediate term low. They may attack that at a later time, maybe later in the year, or maybe even this week, depending upon what happens. But given the current market conditions and the market structure that's in play right now, I feel comfortable with working with the 93.50 level as a potential run. All right, let's go over to euro dollar. All right, so here is the euro dollar. So our 15-minute time frame. As I said, we'll look at the lower time frames, and then I'll close it with looking at the higher time frame across daily, Dixie, euro, and cable. A little bit all over the place, I know, but my annotations are specific to the lower time frame. So we're going to clear up that first, and then we can go to a blank chart on the higher time frame dailies. All right, so we're looking at the 15-minute euro dollar here, and right away you should see this fractal and know what it is. The ICT market maker sell model. So we have relative equal highs. It runs that, rejects, breaks down, comes back to the breaker. So this is your curve. This is the high, and then draw that straight line down, imaginary, or if you need it, put it on your chart, and then start matching up all the down close candles over here, match up with a short-term high or a shorting opportunity. Same thing here, this low, draw that out in time, bam, we get that. And we have the original consolidation over here, that low, draw that out in time, and it's going to attack that liquidity. All right, so I'll add the annotations now so you can appreciate what I just said. Buy side liquidity pool runs up into our 120 objective. Remember, we were looking for 120 as an upside target. We finally reached it. Now, it took a little bit of time to get there, and I left a lot of trades on the table, but guess what? That's what I taught you. I don't always capture that last portion of the move. And I'm also teaching you how I'm comfortable with letting certain price action moves occur without my participation. So if I don't have a lot of confidence or conviction with the trade, even though I may feel it's going to go a specific location or level, I'm content with that, because if it trades to this level 120 and does what I've been warning may have been happening all along, which would be intermediate term high forming, we have it now, and we have a break in market structure. Okay, what's the break in market structure? Well, we hit our objective 120. Then this short-term low, once that broke, that's a break in market structure. So now we can anticipate what? A move lower with this fractal being a market maker sell model. All the things on the buy side of the curve, everything to the left of this line, which is the highest point, everything is a short-term low over here that's a buy, has to be canceled out and mitigated as a shorting opportunity. That's what the algorithm's doing. Over here, same thing here. And original consolidation, sell side liquidity pool, that's going to be what is attacked, okay, where they're going to take the market to. Hit the breaker, it sells off. Mitigation block, sells off. Optimal trade entry, fair value gap, bearish order block. I don't want to zoom in, but there's a 15-minute order block that's bearish here. It's a little green candle there. We're trading up into that. So there's an overlap of a bearish order block, bearish breaker, and the old 18th of August high. That's what this level is. And once I'm done talking about this, I'll scrub over, you can see it. But the curve is shown with the highest high, bearish order block, mitigation block, optimal trade entry, working the original consolidation, and then digging deeper in for the sell side liquidity that will be residing below here. Now there's an order block in here and a fair value gap, so it does have a little bit of overlap with that and digs into it there. Like I said, I would like to see it go lower and allow dollar to reach for that 93.50 level. So that's what I'm looking for. That's what I'm trying to work with going forward for the rest of this week. But I've already given you the parameters that would change that. That 92.20 giving up the ghost in dollar changes all of what I'm outlining here. All right. Let's look at that line over here. I told you that's what this is. The August 18th old high. So if we look at an hourly chart, all of this business on here, it's a lot of notations on this. Here's the old high. We traded above that, and we hit our 120 level. Once it hit 120, I'm done. I'm not worried about trying to capture anything on the long side. And you can see a lot of other people had the same idea. So hit 120 and really broke down. So if we start to sell off and this is an important high like I believe it is, we could be working inside of a larger market maker sell model, and then we would be attacking the sell side liquidity around that 117.50 level. Okay, so about 100 pips below where we're at, basically 1 penny lower than where we're trading. We could spike up into this area here, work in some of this range, and then give up the ghost and go lower. That's reasonable, but I just rather see it not do that. I'd like to see it leave that gap open, and that could be like a measuring gap. So we would see the high down to the low, take that range and subtract it from this gap, and that would really project us down into the 1740-ish level or so. And I'm just eyeballing it, so if you're going to do the actual measurements, you may come up with a different number, but I'm looking at 1740 is comfortable. And then we have the old lows over here. They come in around 1715, 1720, so that could be also a level that may be reached for if we do in fact break down. All right, let's go over to cable. Okay, you can see the cable market. We traded up into the 134.80 level. Didn't quite get to 135, but we had a nice reaction in here. Overall, you should be able to see the market maker sell model. Okay, and I'm going to give you the annotations now. Okay, so we have market maker sell model on the 15-minute time frame, and as I teach in the core content, if you have not gotten this far in the core content, I do cover it, but it's the trend line phantom. We have a low, all these lows here projected in time. Retail would see that as a buying opportunity, but it's not. We trade up into a fair value gap. This is institutional order flow entry drill on an hourly chart, as you'll see when we go up to an hourly. But when we break the trend line, we don't even get that retest that everybody looks for in retail. Then even if that is what they see, they can see it as a shorting opportunity. They deny them that. You see that? And then the market runs away. What is it targeting? It's the midpoint or the middle touch of the trend line. Okay, so that's where your attention always is. That's exactly how I teach it in the mentorship, and that's exactly what it aims for here. It trades down into it there. Not to mention, let's take this off because it's no longer salient. I've already covered it. Original consolidation, reaccumulation, another level of reaccumulation, smart money reversal, low risk sell, redistribution, redistribution, another level of redistribution, and takes us down below to the sell side liquidity pool here. All right. All right, so I've zoomed in a little bit here with the 15-minute fractal on cable. You can see the original consolidation in here. And this is actually these blue lines here, that's an hourly fair value gap, and that's what's trading down into here. Then we traded off the consequent encroachment, rallies away. Institutional order flow entry drill, again, on the hourly chart, you'll see that. Another level of institutional order flow, rallies up. Nice optimal trade entry, and then slams it up into the 80 level, institutional. Price breaks down. Smart money reversal is here. Low risk sell, fair value gap, bearish order block, then breaks hard. This short-term low here being broken there, that's your strong confirmation, if you will, that we're going to be going lower. So everything on the down close candles to the left of the curve. Okay, the curve is the highest point. So this is all buy side. Now all the buy side has to match up with the sell side. So you're getting it here for a short there. So they're mitigating that. All the longs that were here are being mitigated over here. And then attacking the sell side liquidity there. And all of that right there is what they'd be aiming for. Remember, this is your signature that we would anticipate a low resistance liquidity run. Why? Because each high to the right of the lowest one is higher. So that is a very classic signature for IPTA to run those lows. You can see they make a very hasty run to that there. And now we're trading here. All right, so let's drop into an hourly chart for cable. All right, so here's the hourly chart, and you can see here all the down close candles prior to the price runs higher. They have an alignment with short-term highs that sell off. Same thing here, down close candle right before the price run higher. That's your shorting opportunity over here. And then we run below these lows here. and run to the mean threshold of this down close candle, which is a bullish order block. Cable is the one I'm a little leery with, because I mentioned in previous discussions that you need to be monitoring the euro pound market, and it's weak, and it's gonna most likely trade down into its relative equal lows right here, and we're real close to it. So with that said, cable can stay firmer or even rally, and euro can drop more. Be mindful that we could see that occur, and I'm only aiming for this here. Whether we accelerate and then eventually run down here, I don't want to go so far to say that, because I don't know. But right now it seems like euro has the better chance of going lower because of the euro pound being underlyingly weak here. Going back through and cycling through the currencies for the daily, here's your cable chart. And we traded up through the rejection block here. We traded up to consequent encroachment of the wick here. As I mentioned, we would likely trade to, and never made it to the high. It's okay. It's already done enough in my opinion, but I'm not ruling out the fact that the Bank of England could just do something really nasty and run that high out. So just be careful. That's the reason why we preface it by saying don't try to pick the tops and don't try to pick the bottoms. Try to work within the meat of the market moves between obvious turning points. So if we get some decline of significance, okay, there's a lot of liquidity all below this big balanced price range. So if it goes hard lower and dollar finds some wings and goes higher, then we could be attacking that 29.80 level, 130, 129.80 in that area. Okay, so again, that's assuming a whole lot, and I'm not trying to make the case that look, we should be selling short here and looking for that. I'm just putting it in record because it could happen, and if we start seeing things really break down, that would be where I'm going to be focusing for cable. Going over to euro. Euro looks really, really toppy. We've had 1, 2, 3, and then finally this one, and we got a nice reaction so far. So let's play devil's advocate for a moment, and let's say we have to come all the way back up and to hit this low here. I'd rather it didn't do that. It can come back up and hit this candle's low, which is the bearish order block. I'd rather it not do that. I'd like to see it trade a little bit into this. Okay, that's reasonable, as I outlined in the mentorship teachings, that as long as we split the candle in half, the next sell signal should be in the lower half of the previous down closed candle if you're shorting, and then we can make an attack on all of this right in here. I mean, this is just really juicy. It's just like a big billboard sign flashing, hello, hello, I'm here, take me. And the same thing over here. So we have sell side liquidity resting below here, and then we have a fair value gap here. So I want to throw this line on, and it's going to bring back everything else on the chart, but I just want to have it on my charts here. So we could be seeing it trade down into 1660, 1650, but how we trade there, or if we trade at all, again, is up in the air. But if we really continuously show willingness to go lower, this is where I'm focusing, okay? The 92.20 level, if we trade below that on the dollar, though, all of this goes to the back burner, if you will. I'm not going to be looking for it right away then. It still would be a future catalyst for downside objectives, but everything hinges on that 92.20 level for me right now. And it might change. It may require me to revisit that level because of what trades tonight. But looking at the charts as it is right now, that's my line in the sand. And then now Dixie on its daily chart. And again, let's take this off so it's clean. So we've had multiple attempts trading lower. Okay, we had equal lows taken here, and then one more time for anybody that likes to trade equal lows and thinking that's going to be a reversal. They really took it one more time, and now we've shown a willingness to want to rally. There's a lot of buy side liquidity at that 94 big figure. Fair value gap in here, another fair value gap there, and right in here is just, to me, if I was making the market for a dollar, I would run it to 95.40, 95.60, and deny the traders of a retest of that low. So it depends on what we see, but it just looks like we could get some really aggressive run up there if it's going to happen. And again, if I was making the market, I would do it really aggressive, hard, maybe 1, 2, 3 days at most of a rally, and then peter it out right around in here. Everyone at that time would think that the low is in place for the dollar, and then I would landslide it and take it back down and crush this low. That's, again, what I would do if I was making the market, but clearly I'm not making the market for dollar now, am I? So that's the business there. I just want to mention in closing the S&P, we are really soaring on this as we were looking for it to do. So we cleared the gap, found support at the gap, and then now performing just like I outlined it should do. All up closed candles, soaring up there like the NASDAQ has been. So next objective is 3,600, and if we get there, you just want to look at every 100 point threshold, because we've never really been here before. So the question is going to be is, well, how do you pick targets? I'm just looking at 100 handles, and it's all you can do. There's nothing really saying that it can move in 100 handles and as objectives, but that's how I'm looking at it. The closer we get to 4,000, I'm gonna be less interested in looking for it to go higher. One of the things that I don't want you to forget about is this is a seasonal tendency for the stock market to trade lower and create a seasonal low in the fall, like usually between the last portion of August, which is essentially what we just left, into November at the latest. It usually makes a low. The difference is we've had all of this COVID-19 stuff and the crash that occurred here, and the subsequent revisit to the new highs. I mentioned that we should see all-time highs, but it's kind of wonky right now because of everything that took place in the earlier part of the year. We really haven't had a decline going into the fall, so it's just raging across all the months that would usually set up a decline. So this is all new territory for me. Okay, as I mentioned, I've been very upfront in disclosing that because of COVID-19 and its impact and what everyone was dealing with all around the world. No one could really sit down and say, "Oh, I know what's going to happen." And I clearly, as you can see in the recordings, I was being honest. I didn't know what to expect, except for the crash. We called that. I went down to my 2,200 level. Didn't get to my 2,000 level, but I said, if it's going to go higher, I'll know about it. And then we started calling it higher in here, reaching into all of the volume imbalances and then all these objectives we were looking for. So it's all in recording. You can go back and look at that if you've been here just a couple months and you weren't back in here. You can go watch and see all that stuff. It's in the archives. But I really think that there is never been a time with this much risk, but also at the same time, there's never been so much potential opportunity. Okay, so I'm going to give you a scenario in closing. I am not stating that I am voting for Trump, and I'm certainly not voting for Biden. What I am going to say this: if Trump wins the White House again, if the Republicans keep the Senate, if the Republicans get the House of Representatives, this stock market is going to explode on the upside. It's going to go vertical, like it's going to go parabolic, extremely, very, very high. If Trump loses, okay, if Trump loses and we lose the Senate and the House is kept by the Democrats, I believe that we will see a crash bigger than this one. Okay, so that's my only tinfoil hat portion of the video. That's my personal belief, and I'm only making that on the basis of their school of theology, how they want to raise taxes. Raising taxes is going to kill any potential growth in the economy, and I'm hoping it doesn't happen. Let's put it that way. And you shouldn't want it either, especially if you're in the States and you're trying to grow into an affluent lifestyle. You don't want to be paying a lot of taxes, and I'm certainly not wanting to pay a lot of taxes either. So trust me, I pay my fair share. Okay. Soybeans. I counseled you all to look at the November contract, and here we are. So we have relative equal highs in here. So that's where soybeans is most likely reaching. This move from here to here, and then from here to here, and then from here to here. Okay, you all know what that is. Okay, you know how to work within that. I mentioned that this was going to go higher even in the YouTube video. I also mentioned that how this gap was going to be a target, but we also learned this gap idea is not filled and forget. It's fill. If we trade above it, it's going to act as support. Isn't this awesome? You keep getting all this extra stuff. Hold on one second. Let me scrub this over a little bit more. There you are. Some of you are thinking, like, what's a soybean? I remember when I first started learning about commodities, my uncle would talk to me when I was 16 years old. He'd say, yeah, soybeans are going to do this. And so I'm like, what's a soybean? Soybeans are in a lot of food. You don't realize it, but it's everywhere. But we have a gap, and it's really not drawing correctly. There you go. All right, so there's your gap, and the market trades down into it here and then finds some bullishness. What is also here in addition to that gap being retested? You have a breaker. You have a low, a high, and the lower low. And then price runs. Next objective is $9.72 a bushel, and then the $9.90, so $9.90 a bushel for soybeans. And you can see the order block, optimal trade entry here, and another one here. Order block, fair value gap, sell side liquidity taken, bam. So it's not just a Forex phenomenon, the things that you're learning. And you're probably thinking, well, big deal with soybeans. Okay. If you bought here and you're holding here, you're holding $5,000 profit for every contract of soybeans that you're trading long. So from here to here, that's $5,000. Now, if you traded options, you could potentially be holding 5, 10, 20 of them, okay, and risking hundreds of dollars versus thousands of dollars of potential risk. And if one is potentially offering right now at market pricing, it's $5,000 per contract. Well, then if you had 10, that'd be $50,000. Now, I don't know about you, but $50,000, if I lost it, I'd miss it. If you earned it, wouldn't that feel incredibly empowering? Wouldn't that be a change of financial conditions that would be notable in your life? And if you had 20 of them, 20 call options, that's $100,000, folks. And that's just one move. I mentioned that we were going to start seeing a boom in the commodity market. If I'm accurate, and all the things that are going to happen that are not sounding very fun, this is the beginning of an extremely large bull market in the commodities. So don't think, oh, I'm missing it. You're missing the move. No, I told you, this is starting the process. The big extrapolated moves are going to happen in 2021 when everybody's hungry and there's no food because they're going to use food as a weapon. So there's some more tinfoil hat for you, I know. But that's what I'm anticipating. And these types of moves are going to seem like nothing. And I told you, because of the boom in commodities that's coming, it's because of the dollar weakness. And I told you metals were going to go up. Metals did go up. I told you that the grain market here was going to go up. It went up. I told you coffee was going to go up. Coffee exploded too. Coffee, September 2020. Again, if the dollar goes down, commodities are going to go up. And you've learned that from the lessons in the mentorship as well. And here we go. optimal trade entry, fair value gap, bullish order block, explode, optimal trade entry. Again, gap, bullish order block, optimal trade entry, rally. We have a volume imbalance right in here. Watch that one if you want to pay attention to this one. And we have old highs here. This is over $300 per point. So if it goes 116 to 117, you're making over $300 and some per contract. This market, when it wants to run, it can really run. And then lumber, all the people's businesses and such getting boarded up. Here is what's been going on with all the COVID-19 boarding up restaurants and businesses, and also everyone trying to move out of the cities and buying houses. This is what you get. Parabolic mega trade. Okay. Big old move. I mentioned before, when lumber is traded, it's very thin, but when it moves, it really, really moves. And here you have it. So again, this is just a precursor. If everything I'm anticipating is going to unfold and all the nastiness and the bad things that's coming, if that does in fact happen, 2021 is going to be a wildly crazy bullish market for commodities, and you've not missed anything. Trust me, it'll be a historic year in commodities. So with that, I'm going to wish you good luck, good trading, and I'll talk to you tomorrow on a YouTube video, and then on Friday with our weekend edition of the ICT Mentorship.